Good afternoon, friends, and welcome to Outlook 2022. Restart, recover, rebalance. Thank you for taking the time out from your busy schedules to join us today. I am Wanda Beltran from the Metrobank Trust Group, and I will be your host and your moderator for this afternoon. In order for you to have a better idea on what this event is all about, we've prepared a short video presentation. Let's all watch this.
We have to understand that we must be prepared to battle this virus for the long haul.
So it's kind of moving, even more negative. Again, really influenced by the extent of the lockdown.
The labor-intensive tourism sector was one of the first and hardest hit by COVID-19.
Overall, we are confident that banks have the capacity to finance increased loan demand from productive sectors of the economy.
I hope that video has added to your excitement for today's program. So to start off, let me bring you the Senior Executive Vice President and Treasurer of Metrobank, who has oversight of the bank's financial market sector, covering treasury, wealth management, private banking, institutional investors, and asset management. He also serves as Vice Chairman of the Board for AXA Philippines and is advisor to the Board of the First Metro Investment Corporation and Metrobank China. Ladies and gentlemen, here to welcome you with his opening remarks, Mr. Toto Tansingco.
Ladies and gentlemen, in behalf of our Chairman Arthur T., our President Fabian D., and the Financial Markets team of Metrobank, it is my pleasure to welcome you to our Market Movers special webinar entitled Outlook 2022, Restart, Recover, Rebalance. It has been 2 years since the start of this pandemic. During this time, we have seen major changes in the world: the dizzying heights of the US equities, the decline of China as an investment destination, and the Great Resignation. The impact is also very personal. We lost a lot of good people. Our personal freedom, ability to travel the world, and even just outside our homes curtailed. Mental health and quality of life have all become victims of this pandemic. We saw the best and the worst of people. We saw the best from our health workers, who despite the risk continue to serve, and the worst from the hoarding of some developed nations of vaccines, making it clear that in their eyes, their lives are more precious than ours. As we get into the third year of this pandemic, we ask, now what? As the late South African apartheid hero Bishop Desmond Tutu said, hope is being able to see that there is light despite all the darkness. We hope that we can give you light with the theme of our webinar: Restart, Recover, Rebalance. With all the challenges that lies ahead, we hope that we can convince you that by working with a trusted partner like Metrobank, opportunities abound. Finally, we hope that our webinar this afternoon will give you light to help you navigate the uncertain. Enjoy the rest of the program. Thank you.
Thank you, Sir Toto, for those encouraging words. Now on to the matter at hand. Our first speaker is primarily responsible for Metrobank's macroeconomic research, financial and capital market analysis, and related thematic research, enabling the bank to make more informed business decisions, improve operational efficiencies, and help increase revenues through the use of data analytics and advanced statistics for business analysis. Formerly, he was also the officer in charge of the Internal Capital Adequacy Assessment Office of the entire Metrobank Group, which covers both the bank and its subsidiaries, First Metro Investment Corp., PS Bank, Metrobank Credit Card, and Oryx Financial. This office was tasked with the implementation of Basel III in the Philippines and the integration of risk management with capital planning. Please welcome Vice President and Head of Research, Mr. Marc Bautista.
Good day to everybody. This is Marc Bautista, and please allow me to walk you through some of our key talking points for today. First of all, we're going to talk about our takeaways on COVID. Then we're going to walk you through the impact of COVID on the economy. Next, we're going to talk about the Philippine economy and how we've potentially adapted to COVID, especially in 2021. And then we're going to talk about our outlooks and calls. So first off, this is a slide on global COVID situation. And we're showing here that the global confirmed cases are really off the charts. Thankfully, the daily deaths have come down, even though surges have gone higher. And this tells us that potentially the vaccines have been working, the treatments have been working. Natural immunity of those who were previously infected with COVID, it's kicking in. Potentially, there's less pathogenicity for Omicron. And therefore, it is not safe. There are less deaths and severe cases this time. What's our view on COVID? We're basically saying that this is a pandemic of the vulnerable. It's not a pandemic of the unvaccinated. Anybody who's vulnerable, they need to take measures. And vaccination does protect from COVID, and that's one way to do it. However, we also need to count the natural immunity of those who had previous infections of COVID. And it does protect, and potentially it's even better than the effects of vaccination. However, none of them works 100%, and therefore treatments should be considered. Experimental treatments like monoclonal antibodies, etc., they are workable, especially for people who cannot take the vaccines. And basically our view is that COVID will be endemic. It should be plotted in our business plans that it's going to be there, it's not going to go away. So mass social distancing, workarounds, and shifts, hybrid working, they're here to stay. We need to take a look at robust plans for surges and lockdowns, which are to come. And we think that socializing and bringing down the cost of testing should be part of the big plan, especially as we prepare for living with COVID pandemic. In 2020, it destroyed a lot of demand, and that created low inflation because not a lot of people were buying. All of us were in lockdowns. Now in 2021, when vaccines came in and people started going out and there was a restart of the economy, then we saw high inflation because the demand came back in, but the supplies were not yet ready. There was a lot of problems with COVID supplies because the supply chains were basically adversely impacted. For this year, we still have the continuing episodes from 2021. You still have those supply chain disruptions. It's still not yet there. And on top of that, you're getting the U.S. doing a lot of fiscal spending on infra and potentially from their Build Back Better plan, and which is bound to be very, very inflationary because it's going to add up to demand on top of the current demand, and with the supply chain still in disarray. Therefore, we're seeing a lot of inflationary pressures for the globe and for the Philippines. Now, as we've seen over here, the Baltic Dry Index went up although it has come down. What's the Baltic Dry Index? The Baltic Dry Index is about the shipment of goods. So if the numbers are high and they were way off the charts in 2021, that simply means there's a lot of goods being shipped around. It went down eventually simply because towards end of last year, people started pricing in the impact of Omicron. Markets were deciding, well, it looks like there might be lesser demand, and therefore that got priced back in. And therefore we were seeing some drops in some of the key indices like Baltic Dry Index, which is about shipping, Brent crude, which went up and then it went down, but currently went up again, and last I saw it was doing around 80 plus in terms of price per barrel of oil. So that's going to be inflationary. It's going to translate to the Philippines as higher inflation. Coal also went down, but it was way off charts again last year, then went down simply because China started ramping up their supply again. We were seeing the markets also pricing in lesser demand, but it went back up again, especially lately because Indonesia is restricting its exports of coal. Now, with oil prices and coal prices that high, we expect higher inflation for the Philippines and potentially some problems going into the summer. In terms of the commodity index, it really also went up all the way to 2021, came down again because of Omicron being priced into lower demand, but it's coming back up again. And as we see over here, these are some of the key indices, and some of them have been growing double digit. Crude oil were at times growing at triple digits. Now, talking about the Philippines, we came in at 7.1% in the third quarter of last year. It looks like investment spending and consumer spending are contributing again to GDP. What we saw is that despite the lockdowns, especially in the second and third quarters, the GDP numbers continued to grow, meaning that already tells you that a lot of the impact of COVID is already being affected by the markets, and they were able to do some social adaptations and economic adaptations, which allowed the economy to grow. And we think that this could continue in 2022. The problem now is that people are also getting sick at the same time. This Omicron surge is not quite done yet. We're hopeful that those social and economic adaptations from last year will still push through this year. And here you are, these are the key GDP components. So consumer spending has grown, government spending, capital formation, net trade. We're net importers, as you see that the numbers are down there. But that's highly correlated with capital formation, or what's called investment spending. So that tells you that a lot of the things that we need from abroad to continue with our economic growth, we're still importing them on a net basis. We're still importing and exporting, but on a net basis, we're doing importing. So that should bode well for the Philippine economic situation. Our peso is highly affected by expectations of what the Fed will be doing with the Fed funds rate. And right now, what we're seeing is that peso will continue to weaken as the Fed starts hiking rates. And this is what we're seeing right now, that the Fed will start hiking rates this year and continue hiking rates all the way up to 2024. And that should tell us that the dollar will strengthen and the peso will weaken. It's not really a problem for us, especially because our OFWs, they're continuing to send their remittances at record highs. So there's going to be a lot of support for the peso. So that should provide some counterbalance to what the Fed will be doing and their tightening of monetary policy in the U.S. For our debt, it's still manageable. The government is expecting the debt to GDP to go as high as 62% and then eventually come down to the 60% level by 2024. That should be workable. We're still in a good spot because we still have our flows. And here are our forecasts for 2022 and 2023. We still think that the economy will be growing anywhere between 6 and 7%. For 2022, it's going to come in at around 6.8%. Now, inflation, we're expecting inflation to run anywhere between 3 and 4%. And for 2022, we're expecting it to come in at 3.4%. We're expecting the BSP to hike rates by second half from 2% to 2.5% and to 3% next year. For now, we're calling 50 basis points this year and 50 basis points next year, but it could still be higher. Our dollar peso forecast be 52.1 for this year and 53.4 next year. Okay, so here are our forecasts alongside the consensus. So that's all we have. And we'll be very, very happy to take your questions later on after the next speaker. Thank you very much and good day.
Thank you, Mark, for that informative and insightful presentation. Now, I'm sure you have a lot of questions for us today, so please may I remind you to key them in so that we can take them up later during our question and answer portion. Moving on to our next speaker of the afternoon, he is the market strategist of Metrobank's financial market sector, joining the bank in 2016 after 14 years of working overseas in Singapore and London as Director of Asian Equity Sales for UBS, Credit Suisse, and the Bank of America Merrill Lynch. Please welcome First Vice President and Head of Institutional Investors Coverage Division, Mr. Ruben Zamora.
Good afternoon, everyone. My name is Ruben Zamora. I head the Institutional Investors Coverage Division and Financial Market Sector in Metrobank. Thank you for joining us this afternoon and allowing us to share our views on financial markets. It is 2022, not 2022. By that, we mean, as you heard from Mark, that we are recovering. We saw recovery and really a path to normalization already last year. We'll continue that this year, as you heard from Mark. As we enter the financial markets as 2022 and our positioning for financial markets, we would look at portfolio allocation for your investments to really favor or continue to favor equities a little bit more than bonds. But that really is because we'd like you as the investor to time the peak in rates in peso bonds. So we'll kind of walk you through that a bit more. So a 10% allocation in cash is really meant for you to deploy that and be when the opportunity in both bonds and in equities present themselves. And we also share with you in our usual risk bit chart here or diagram here, our breakdown on dollar peso and preferences. The themes in 2022, stronger dollar versus the peso. We already saw some of that price action in the beginning part of this month. We'll walk you through why we see that and really consistent with what Mark said in his presentation. As I mentioned, for our asset allocation preferences for 2022, we will be opportunistic in peso bonds. We think rates will rise, but not as much as what we saw in 2021. But we want to take advantage of some of these bonds when they peak, when the rates peak, when the yields peak, and therefore lock in a higher yield for your portfolio. And lastly, for equities, we will be selective in peso equities, favoring really some of the stocks that will perform well when rates are rising. 2022, not 2022. What do we mean? 2020 was a year where everyone suffered pretty much uniformly. Recessions globally, including the US. So you can see in the GDP chart here that everyone was in the same boat. But so 2022 this year, not 2022. But 2021 was very different. 2021 saw an even recovery between the haves and the have-nots. Haves being the US, have-nots being the developing countries, including the Philippines. What do I mean by that? Well, the size of the US economy at the end of 2019 was $19 trillion US. By the end of last year, it hit $19.4 trillion, so larger. So this big snapback in economic recovery. The Philippines, however, well, in contrast, we ended 2019, the size of the economy, 19.4 trillion pesos. By the end of last year, we were still lower than that, 18.5 trillion pesos. So we do think, as you heard from Mark, that the Philippines will play catch up in 2022. But overheating in the US, this big snapback in recovery carried over some issues of overheating. And that will have a major impact in our investments in our markets and therefore how we would approach your portfolio this year. What do we mean? In 2021, we saw U.S. inflation hitting 40-year highs. So it was this inflation shock that really was driven by unprecedented emergency monetary and fiscal stimulus that the Federal Reserve particularly introduced in 2020. So this inflation shock is something that they can't keep and leave alone. So they have to do something about it. And what they need to do is really, kind of scale down, pull back some of these emergency monetary measures in order to ensure that, quote unquote, higher inflation does not become entrenched. And again, that's something that Federal Reserve Chair Powell said last week in the Senate testimony. So what do we mean by pulling back and scaling down some of these monetary stimulus measures because they're no longer appropriate given the big snapback and recovery? Well, this includes rate hikes by the U.S. Federal Reserve. And it could potentially mean moving from that inflation shock last year to a rate shock in 2022, potentially. Just to illustrate, last September, the market was expecting 2 rate hikes by the Federal Reserve for all of 2022. But by December, 2 months later, the market readjusted very quickly and started pricing in between 3 to 4 rate hikes for 2022. And potentially, those rate hikes can happen sooner than later, with rate liftoff or the beginning of these rate hikes already coming in this March in the FOMC meeting. Along with the rate liftoff in March, the Fed is also going to end their quantitative easing, bond buying, injecting liquidity into the system by buying bonds from the market. So therefore, what that means is by ending bond buying, they won't be injecting any further liquidity, and they'll do that within March as well. The original plan was to end bond buying by the middle of the year, but now it's compressed to March. And therefore, they'll be draining liquidity out even faster, along with the liftoff in the rate. So it's really tightening of liquidity conditions in order to arrest inflation and really pull down headline inflation. The other signal that the Federal Reserve has done, again, more tightening, more draining of liquidity, more scaling back of stimulus that's no longer needed, given the stage of recovery they're at, is a running off or reduction of their massive balance sheet. So that's another tool that they've already signaled they may use should inflation remain persistently high. US policy appropriate for their stage of recovery versus BSP monetary policy that's appropriate for ours. That's the main difference. There's a big divergence. Therefore, what does that mean? US rate hike will start in March, but for us, because of our stage of recovery, again, we're still going to play catch up in 2022. We're going to raise rates. So BSP will raise rates only in the second half of the year, most likely, at least in our view. And therefore, there's that kind of 6 month or so lag between the first rate hike of the US and our rate hike. And therefore, that's going to affect the dollar peso rate. Why do we know this? We've seen this. We saw that in the last tightening cycle of the Federal Reserve, December 2015 through 2019, the red line being dollar peso rate. Again, you can see how the purple line, the Federal Reserve rate, kept rising while we kept ours steady. So that really affected the dollar peso. It's kind of playing out similarly through this year, in our view, and next year as well. Again, Marc's forecast is for the dollar peso to end this year at 52.10 and to end next year at 53.40. The other reason why the dollar will likely be strong versus the peso is importations. With the path to normalization, that means the resurgence of domestic demand for imports, a return to what's really a more normal state of a current account deficit as opposed to a surplus in 2020 and a balanced current account in 2021. What does that mean? We import more than we export. So that's more normal when domestic demand is very strong. Therefore, that implies further pressure on the peso, upward pressure on the dollar peso rate. We already saw importations exceed pre-pandemic levels in the first 10 months of last year versus the first 10 months of 2019. So we do see that coming through even more this year and next. Other BSP accommodative measures that they're going to be much slower versus the U.S. Federal Reserve is liquidity. Again, I mentioned that the Federal Reserve will be draining liquidity out of this system because that's their stage of recovery. BSP will keep excess system liquidity remaining near record highs. They've also signaled a potential reserve requirement ratio cut if necessary, so injecting even more liquidity in order to support rising loan growth. We already saw loan growth kind of turn the corner last year, so we do see that kind of approaching pre-pandemic levels through this year and next, and therefore you need liquidity to kind of keep that engine running, to keep activity and fuel activity in the economy going. This excess system liquidity actually was very important over the last 2 years. Why is that? Because while no one else was borrowing, the government had to borrow and borrow a lot. They had to borrow a lot because they had to spend a lot to keep the economy going and keep activity supported. So these outsized government borrowing programs in 2020 and 2021 were really helped by the high system liquidity. And so going into this year, 2022, they're not going to borrow as much as 2020 and 2021, but they're still going to borrow a lot. Why? Because they are still looking at fiscal deficit spending to keep, and support the economy and make sure that recovery really firms up. So with the 2022 borrowing program still sizable, that means there's a lot more bonds coming through. That more bond supply equals higher rates. But when we look at the year-end 2021 cash position of the BTR, our calculations do suggest that they pre-funded some of their borrowing requirements for 2022 already. That'll help, because if you pre-fund something, you don't need to raise it this year anymore. Therefore, you have some potential flexibility if you're the borrower, meaning the Bureau of Treasury, in terms of maybe down the line rejecting some high bids. We kind of saw that, or high bids for higher yields, We kind of saw that towards the end of last year when the BTR started rejecting some high bids in their auctions. So there's some flexibility there, but we do continue to see rates rising in 2022, and I'll talk about that in a bit. In terms of where this still sizable bond supply is going to come from, it's going to be in the 3 to 5 year tenor buckets, we think, because it's just a way for the Bureau of Treasury to manage the maturity profile. So pushing it out to beyond 2024, really spread out all their maturities and obligations. There's also, as I said, when the U.S. tightens, that pushes up long-term yields in U.S. 10-year treasuries, and there's a relationship. You can see the red line kind of synchronized with rises and dips in the green line, U.S. long-term bonds and peso long-term bonds. So we tend to kind of rise and to a certain extent anticipate further rises in U.S. 10-year treasuries. So that tends to pull long-term rates higher. And that's really the direction we see for U.S. Treasury bonds this year and next. So what does this all mean in terms of your bond portfolio? Well, rates already rose a lot last year. It moved up, particularly in the long end of the curve, by almost 200 basis points, some of them actually higher, particularly the long end bonds. Why? Because lots of new bond supply. Government had to raise a lot of money for fiscal deficit spending. And as I said earlier, last year, the Bureau of Treasury had to kind of raise these funds and therefore sell, retail Treasury bills, for example, at above current market rates just to get the demand for their bonds. And so they were kind of willing to award, bonds at higher rates. We think it's going to remain the same this year, again, because of the sizable borrowing program of the BTR, the still sizable borrowing program of the BTR. There's also, as Mark explained, our expectation for 50 basis point rate hike by the BSP just to kind of normalize, but they'll delay it, they'll wait until the recovery is a bit more firm, plus rising U.S. Treasury yields. So when we look at what we're facing for bonds this year is higher rates, but it's not a 200 basis point move anymore. we're looking at maybe a maximum of about 135 basis point move, particularly where there's a concentration of new bond supply, as I said, in the 3, 4, 5 year, 7-year space. So those are the opportunities we would wait for in peso bonds this year, because we do expect that to peak, and we want to catch the peak in these yields, particularly if the BTR is willing to pay a premium to on market rates the way they did in the first and half in the third quarter of last year. So that is really where we would be waiting for that opportunity. As the rates rise, you'd want to be looking at opportunities towards the long end of the curve. And for the dollar proportion of the fixed income holdings, well, in general, U.S. tightening is bad for bonds, but we are seeing some relative value opportunities in credits, in not just sovereign bonds, dollar and non euro denominated bonds, both sovereigns and corporates. But we will be opportunistic as well in looking for those that offer relative value, strong domestic franchises with robust cash flows. Again, higher rates means that they'll have to deal with higher payments, interest payments. But we are looking at certain ideas here, particularly in the Asia region, because that's a region, including ours, that has yet to really fully realize gains from being reopened and the recovery. What about equities? As I said, we're selective in equities. With rates rising, we do think that there are pockets of opportunity in equities. Philippine and Asian equities in general lagged US and European equities in a big way last year, largely because of continued vulnerability to COVID surges amidst lower vaccination rates, as well as China's zero COVID policy. So that's what you see, the Hang Seng Index and the Asia Pacific Index, the blue and the violet lines. But you can see the red and S&P 500 and European stocks are green, rising through last year. But what we are seeing with rates rising, particularly in the US, that's weighing on high growth stocks, particularly tech stocks, your FANG stocks. And that's, you can see, driven a rotation towards value and away from growth stocks. And you can see that in the US S&P Value Index relative to growth and Asia. So we did see that already in the beginning part of the year. So we do see that continuing this year. So overall, for local equities, the trend of rotation into value versus high growth stocks does favor the PST because, as you can see in the valuation charts, our valuations aren't that demanding and still undemanding. And again, we do still see the tailwinds to earnings from an economy that's still about to fully restart, about to fully recover, to really be priced in, and all those gains to be priced in. So we are looking at a base case of 8,100 as our PSE target this year, as well on the best case at 8,400 from about 7,200 now. And lastly, in terms of where we would be selective for our restart and recover themes, we do favor stocks that are more liquid, that still offers value, and again, strong underlying franchises with resilient cash flows with rising rates. You don't want to be subjected to those that are over leveraged. Again, given the uneven path to normalization globally, and therefore our favorite themes, e-wallets, data demand, banks, because they are, again, value more than growth, ESG, and conglomerates. That's the end of my presentation. Thank you very much.
Thank you, Ruben, for your very helpful insights. At this point, we shall now move into our panel discussion. Please allow me to introduce our distinguished panelists. Joining Marc and Ruben in the panel are Senior Executive Vice President, Treasurer, and Head of Metrobank's Financial Market Sector. You met him earlier, Mr. Toto Tansingco. Welcome back, sir. Senior Vice President and Head of the Metrobank Trust Group, Mr. Dondi Santillan. Dondi has over 30 years of experience in the banking industry, and prior to joining Metrobank, he was head of trading for the Asian credits at ING New York, ING Singapore, and UBS Singapore. While in Metrobank, he also had a 2-year stint as treasurer of PS Bank. Welcome, Dondi. Next, we have also with us Senior Vice President and concurrent head of the Investment Distribution Division, Metro Manila, and the Client Solution Division, Mr. Ricardo Pedrosa. Rick has been with Metrobank since 2012 and has worked in the banking industry for over 26 years, taking up roles in corporate sales, structuring, and high net worth individual sales. Last but not the least, the only bell in the ball, have Senior Vice President and Head of Metrobank's Private Wealth Division, Ms. Lizette Perez, who has over 20 years of experience in private banking. Lizette is a business economics graduate of the University of the Philippines and has a master's degree in economics from the University of Southern California. Welcome, dear panelists. So let's get the ball rolling. We have quite a number of questions streaming in. So I'd like to begin with Marc. Marc, with the debt levels expected to be elevated, do you think do you think a credit downgrade for the Philippines is in the offing?
All right. To answer that question, we have to understand where we are right now. And where we are, the Philippines is at least 2 notches into the investment grade rating. So we're 2 notches above speculative grade. And normally, if you take a look at the past, the markets tend to move ahead of the credit rating agencies. For example, way back before the 2013 upgrades of the Philippines to investment grade, the markets are already pricing our paper as investment grade, meaning our spreads were very much similar to Thailand or Malaysia. So to answer that, so first of all, we have a buffer. Therefore, if we're downgraded 1 notch down, we'll still be in investment grade, and therefore we'll still be in the radar screens of investors. And then secondly, where we're moving right now, I think the negative outlooks that were made by the credit rating agencies last year was really more a reaction to our dismal performance in the first half, which was really expected for the economy. And I think when the market surprise of upward surprise for the GDP numbers came in at 7.1, when most of the market the consensus was below 5%, that tells you that we're back on track. So to answer finally that question, I think that it's going to be relatively a non-event, especially because the markets have already moved. Our rates have already gone up. For example, the 10-year rates have already moved up, while let's say the US will still they're talking about some more movement over there. Where of course there's still going to be some movement, but we're saying that the credit rating agencies normally just confirm in the past history, taking a look at the past history at least. So it should be relatively a non-event. I think the problem will be more if we move down 2 notches downwards into speculative grade, because that's going to take us off from the radar screens of investors whose requirement in their investment plan is at least an investment grade before they consider debt here. So that's my view.
Okay, so I'd like to get you right. So if it may happen, so you're saying it may happen.
It may happen if it happens. I think that was the question. If it happens,
yeah, will it happen? Actually, will it happen? So is it likely to happen?
I don't think so. I think we're doing well enough. Our economy should be moving forward, and that should quell some of the noises coming from that area.
All right, thank you. Maybe we can get some consensus from the panel. Sir Toto, is that your view as well?
Well, rating agencies are very model driven. As we've seen, they just have to follow what their models say and say it as is. They've actually been very cautious since the 2008 crisis. So they'd rather sound the alarm rather than be aggressive, because there's really no upside for them to stick out. So they might give us a downgrade. It's possible. But what I would like to impart to you guys is that the Philippines is beyond its credit rating. In fact, the spread that the Philippines can borrow right now is way, way above what its credit ratings imply. So we're actually able to borrow at the single A level, even though we're triple B. So even if a downgrade happens, I don't think that the impact will be that detrimental. We have a very big funding base domestically from our locals with large dollar holdings. So I think that it is not as serious as it seems right now. I think that a downgrade is possible. It's unlikely, but it is possible. What I'd like to put on the table is it is not that serious if in case it happens.
All right. Thank you very much. So a non-event to the words of Marc. Okay. So our next question, I'd like to give this question to Don D. With the expectation of faster and more frequent rate hikes in the US and the Fed taper ending soon in March, as a matter of fact, this year, do you think trading clients should start buying the long end of the curve? If yes, when is the best time to start doing so? A very specific question.
Yeah, well, if you look at Ruben's presentation earlier, he showed you the outlook for interest rates moving forward. I think as the Fed and the BSP start to hike, of course, the Fed will hike ahead of the BSP given our different cycles. No? For the Philippines, for instance, he still sees the 5 years going up by 100 basis points. But I personally feel the short end of the curve will probably be harder hit. Right now, we're enjoying low rates in time deposit, or not enjoying, but suffering from low rates in time deposit as investors. So I think that will increase faster than the long end. So we'll see a flattening of the curve. Going long end right now, I don't think that's advisable. Too long end, I mean, meaning beyond 10 years, given that the price change is going to be more dramatic. In fact, if you look at the outlook based on Ruben's slides again, if the 5-year moves by 1%, price points will go down by almost 5 points. In fact, around 4.5 points, 4 points. So whatever income you gain for the year, you'll probably erase. So doesn't look very enticing to enter right now too aggressively. Do we see interest rates back to 7% where they were in 2019? We don't think so. I think we will be happy. At least that's another opportunity to come in. So the rates table that Ruben showed shows that you should start targeting probably the 3 years to be defensive, going towards 5 years and going towards 7 years, more towards the end of the year. Remember, as the BSP and the Federal Reserve hikes, there should also be a shift from equities to fixed income, but not this early. Not this early.
Okay, thank you very much, Dondi, for that. So, Ruben, let's go to you. Do we expect the same rate hikes happening in Europe and Japan?
Well, different cycles. In fact, they're going the opposite way. They need to support their economies differently. I think the outlook for Europe is you saw the performance of the equity markets, and that really speaks to how the monetary stimulus, how more gradual the reversal of the stimulus will be for them. And Japan, of course, especially with rates hiking in the US and Japan kind of being the currency, the yen getting hit the most. That'll help their economy. They're an export economy, but that will they'll lag. These markets will lag the US. Yeah.
Okay, thank you very much. Next question. In Ruben's presentation, there was talk on the divergence of the US and the Philippine monetary policy. I'd like to give the question to Sir Toto. how will this divergence affect the different asset classes, both peso and dollar?
Well, clearly, with the US interest rates hiking and the Philippines will have to be reluctant or slow in raising its interest rates because we really need to grow much. There should be strength in the US dollars. This is not only in with regards to the Philippines, but across all the world. So I'd like to invite people not to focus specifically between the dollar peso rate or the interest differential between the dollar and the peso solely, but look at the relative value of the peso with regards to other currencies, the euro, the yen, the sterling, other Asian currencies. And this would give a better indicator whether the Philippines is indeed undervalued or not. So I would think that with the rise in US interest rates, their equities market still has some legs, but I think it will be at a much slower pace. While the Philippines, I believe, has a lot more upside as we haven't even breached our 2019 levels as far as equity markets and valuations of other assets, including real estate and other investment vehicles. So I would say if keep a substantial part of your portfolio in the dollar because that's going to strengthen, but don't neglect the investment opportunities in the peso because while the US is fully valued and has run, there's a lot of upside in the Philippines. And as was mentioned by Ruben, the equity market has a lot of upside, the real estate market has a lot of upside, and other investment opportunities abound.
Thank you, sir. Now, in addition to what Toto said, I'd like to ask this question to Rick. How will this divergence impact asset swap yields this year? And would you have any advice on tenors our clients can invest in and maybe even some hedging strategies that they can consider?
Okay, so on that, as was pointed out during, in particular, Ruben's presentation, we're going to see a decoupling of monetary policy by the US from the rest of the world, and they will likely move ahead. The consequence of this will be, at least on paper, a narrowing of the interest rate differential between those two currencies. Now, as Toto pointed out, this means that if you were to go into, for example, asset swaps, the time to do so is now. The other consequence of this is going to be that there may be significant opportunities for asset swaps in different currencies. So instead of looking at, for example, US dollar to peso, you can consider asset swaps from euro-denominated assets or yen-denominated assets into Philippine peso, which would offer a more attractive interest rate differential. So that being said, the tenor that we favor right now is the 5 years. It seems very attractive. And in particular, we've been looking at clients doing the RP Euro 27. Okay.
Thank you, Rick. Now let's move on to equities. And this question I'd like to direct to Dondi. Should clients consider, so you've been saying earlier, well, I don't know if you share the same view, but should clients consider a bigger equity allocation in their portfolio? And if so, what themes or trends should they be looking out for?
Okay, I think Ruben shared this slide earlier. We seem to favor equities earlier on in the year. The slides Ruben showed is our expectation, for instance, for the local markets is 8,100, which is only 10% from where we are right now. It's not great. But like I said earlier, the problem with the government securities or interest rate market is if we expect interest rates to go up, then you will suffer some price depreciation, which might offset the coupons you receive, which is why we want to favor equities earlier on. both local and offshore, especially offshore because of the outlook on the peso, meaning if it's weaker, then you'll get an additional kick on the peso depreciation. So I guess going through the year, early on were equities, and then we slowly shift to fixed income as we feel that the peaks are being more at least within our grasp. No, I don't think we'll ever catch the highs or the lows, but that's a call. I think early on it's going to be tough to. I think we have to be defensive on fixed income, and then we become more aggressive towards the end of the year to see the shift between the two.
Thank you, Don D. And maybe as an additional insight, Sir Toto, do you think it's still attractive to consider Chinese names right now with the Evergrande crisis and all?
China will, on the long term, outgrow, let's say, the US. That's a reality. However, the timing is, I think, not the correct time because we're in the middle of a lot of policy shifts. And it seems like these policy shifts within the Chinese government can affect a lot of assets which we thought were relatively safe. There's no such thing in China as too big to fail. We've seen that with Evergrande, Shimao, and even the fact that they're delisting the DD from the US. So I would say that keep an eye out for China, but this year might not be the right time to get into it until we see some stability of policies moving forward.
Okay. Thank you. Now let's move from an allocation from specific asset classes to a total portfolio standpoint. And I'd like to direct this question to Lizette. Typically, how did your portfolio look like for your private wealth clients, and what changes have you done in the last 2 years?
Hi, Wanda. Audio's good?
Yes, you're good.
Okay, so the question is, how does the portfolio look like, and how much changes have we done for the past 2 years? There's no typical portfolio. Each client is different, obviously, depending on risk appetite, time horizon, sophistication. But what I can say for general Metrobank clients is because Metrobank being the biggest bond house in the Philippines, a lot of the clients are actually positioned in fixed income, right? So a lot of the concentration is on fixed income positions, whether it's in the form of government securities, bonds, or asset swaps. Having said that, for the past 2 years or more than that, we have tried to embark on more diversification in order to future-proof more portfolios. We've added more risks. We've added more risks by way of maybe Philippine equity. Likewise for global mutual funds in order to make the portfolios less Philippine-centric, right? So, typically when you look at a portfolio in the Philippines, it's mostly Philippine denominated. So what we've done is we've been able to switch out of the Philippine peso to dollars in anticipation of the dollar strength. And we've diversified out of other asset classes apart from fixed income.
Okay, thank you, Lizette. So now let me try to read some questions coming off from our chat box. So here is a question specific to the multi-themed equity fund of funds. Why is it down when the MSCI ACWI is positive? I think that will be for Don D.
Yeah. Well, one thing, let's understand the thematic fund of funds. No? The thematic fund of funds, over the long term, we're very bullish. It will outperform. These are basically stocks that were ahead of their time, meaning Apple from 15 years ago, Amazon from 15 years ago, catching it early. Particularly, let's say the disruptive innovation, that one performed very well in 2021, largely due to Tesla, but they underperformed because valuations are quite cheap. No? Will they double this year? I don't think so. I highly doubt it. It will probably give decent but more normal returns. But over 5 years, can it double? I think so. That can happen. So really, when you think about thematic, this is really and any equity for that matter. No, these are funds that you have for the long term. You can set it aside and watch it grow. Not have to deal with the day-to-day mark-to-market, etc. More so for thematic. In fact, thematic should just be a portion of your total equity funds. They should not be 100%. They should just be a portion. It will provide you the upside in the long term. So yes, they've underperformed. Earlier, the question was, what themes do I see? Right now, we see a shift to more cyclical stocks, more traditional technology, rather than market-blazing technology. So right now, there's a shift back to traditional, to trackers, etc. But over the long run, we expect this thematic to pay off. Not this year. Not this year.
Okay, thank you very much for that, Dondi. To the speakers earlier, have the speakers factored the national elections for the projections for 2022? And are you seeing already any impact of election spending as well?
All right, so maybe I'll take first crack at the impact. I think we're still in the middle of a big surge, and we still have to take a look at the numbers. So normally we're expecting the kind of consumer spending that comes in, or the kind of election spending that comes in, would start around December, and I think the numbers aren't out yet. We'll see that by end of January when the GDP numbers come out, and it should be good. Based on the mobility indicators that we're tracking, GDP numbers should come in pretty good, and we, except for the Omicron surge we're undergoing right now this January, we'll yet to see if it's going to dent the spending that's been happening since the fourth quarter. So in that sense, my forecast, for example, already assumes that spending is happening, but we'll have to confirm that with data from on the ground.
Ruben, would you like to add to that?
I think just in terms of the election spending impact on the economy, I think we've yet to see it. But one comment on elections, or at least stock market performance, there's a tendency for markets to do well, 12 months before and 12 months after. We've seen this in pretty much the last 6 or so elections that we've had fairly consistently. So I think that's there's still certainly some catalyst ahead for us as we enter the campaign period and post elections.
Okay, so let's touch a bit on oil prices. Mark, how do you see prices moving in the coming months?
It's going to be tough for the last 2 years because of the pandemic. There wasn't a lot of investment spending for production. So and that's created a lot of problems for supply. And right now it's really a supply issue. Then coupled with that, the problems with the US, for example, they were a swing supplier before. Every time there was tight supply, the US would just bring in more oil from fracking and what have you. Now, with the new Biden administration, they've basically reversed a lot of the energy policies of the previous administration, and that means they're way behind in terms of the ability to be a swing player. So that tells you that we're going to be having high energy prices for the time being, and it takes time for all of that supply to come back in. And then on top of that, right now as well, there's talk about potential issues and potentials of let's say Russia invading Ukraine. So that's creating a lot of jitters in the market because right now supply is very, very tight. And then on top of that, you have the problems with logistics and shipping. So it's going to be a rough year in terms of energy prices.
Okay, so it's 4:00, so we better wrap this up. Okay, so last question, and I direct this to all of you. Do you see recovery happening in 2022? So you only answer yes, no, or maybe, and probably one or two statements on why you think why you answered that way. So maybe we can begin with Ruben.
Yes. That's pretty much the theme of our discussion this afternoon. So hopefully you agree with our views. But clearly yes.
Yes, for 2022.
Yes, for 2022. For me.
All right, thank you. And Mark?
Yes, for the coming years.
Yes, okay. And Sir Toto?
Yep, I agree. I think it's optimistic moving forward.
Okay. Dondi?
It's also a yes for me. The fact that the central banks, BSP and Fed, are increasing rates, they also have confidence.
Lizette?
Yes, for me, especially on Philippine equities. If you look back at the index since 2018, it's been at the 7,000 levels. Went down to 4,000 during that brief moment of the pandemic, hovering around the 7,000, and we're still there. So certainly, especially with good election results going forward, we should do really well in the coming years. Yes, yes.
Yes. Yes to the pink anyway. And last but not the least, can we hear from Rick?
It's unanimous. For me, it's a yes. The reason for that is that I strongly believe that COVID will move towards being treated as an endemic sickness rather than being a pandemic as over the past 2 years.
Okay. So, all right. So thank you very much. That's about all the time we have for our Q&A. On a final note, friends, let's all take heed from the title of this webinar, which is Restart, Recover, and Rebalance. That, if we are discerning enough, opportunities indeed abound. Again, thank you very much to our esteemed panelists and for their wonderful insights. And we hope that they have provided you with enough wisdom to help you confidently navigate forward. Now, before we move to the last part of our program, we would appreciate it very much if you answered a very of the survey in the chat box. Please know that your feedback shall be invaluable in our future, in improving our future webinars. Okay, so we hope you take that time out. Okay, so and so we have come to the end of our event. Thank you very much for being here and for your active participation. Now, I'd like to bring back again for her closing remarks, Lizette Perez.
Good afternoon. Thank you, Wanda. And a big thank you to everyone for joining us this afternoon. We hope that we were able to provide you with good insights to the markets as we continue the investment journey together in 2022. I hope that our presenters, Marc and Ruben, salamat, and the discussions in the Q&A earlier with our handsome panelists have provided clarity on how to navigate through the less murky waters of 2022. In summary, our event title, Restart, Recover, and Rebalance, says it all. It's a positive outlook for the markets going forward, Philippine markets. History offers us the gift of 100% hindsight, diba? So we should use this wisdom, this knowledge, to better understand the present and strategize for the future. What can history teach us? How can someone with patient money, meaning investors with a time horizon of maybe 3 to 5 years, how do you create wealth over time? Actually, two things, no? We should take risks, calculated ones. Successful investing is about managing risk and not avoiding it. The biggest risk of all is not taking any risk, di ba? Food for thought. How many millionaires do we know created their wealth by putting their money in a time deposit? Parang wala, di ba? So once you've taken that risk that is appropriate for you and your family, stay the course. Let the plan unfold. The single greatest edge an investor can have is a long-term orientation. Economies are cyclical. There will be recessions, but markets will recover. Markets recovered from the Great Depression, the 2008 financial crisis, and now we are in the process of recovering from the greatest health crisis of all time. So we will probably get through whatever comes next as well. Make sure that you are part of the recovery cycle. That's the most important. The big money is not made in the buying or the impulsive selling, but in the waiting for the expected scenario to unfold. So in this case, we wait for the peak of interest rates, as Ruben and Marc has said, and we wait for equity markets to tell the full story, especially for the Philippines. There continues to be a lot of uncertainty, and uncertainty tames the appetite of the greedy. Maraming takot, di ba? Marami pa tayong hindi alam. We don't know what the election results will tell us. We don't know if there will be another variant that will ravage the economy. So therefore, yes, maraming takot. And I think the advice of Mr. Warren Buffett rings true at this point. Be fearful when others are greedy, and be greedy when others are fearful. Diba? Huwag matakot. So with that, let me thank you all again for your time and for all your business. Please know that your Metrobank family is always here for you, no matter which cycle we are in the economy. Please continue to keep safe and healthy. We pray that one day soon we get to see all of you again face to face. Good afternoon and enjoy the rest of your day. Thank you.
Thank you, Lizette. Dear friend, this has been Wanda Beltran. Until our next session, hopefully live and in person this time. I bid you all a great weekend ahead, and please be safe. Good afternoon, everyone.